mutual funds and hedge funds. So an introduction to mutual funds and hedge funds and the differences between these two financial instruments. So number one, mutual funds. So what is this mutual fund? It is an investment vehicle. Okay, so it is an investment vehicle through which money is being pooled from the investors, like retail investors, high net worth individuals, and institutional investors. I have prepared this small PPT, but I will even write and show it to you now. And this money is invested into various securities. So when I say various securities, it means equities, bonds, money market instruments, all this kind of securities as per the objective of the fund. So each fund will have an objective. For example, equity fund will have the objective of investing in equities, debt fund will have the objective of investing in debt, and money market fund will have the objective of investing in money market instruments, and hybrid fund will have the objective of investing in all these securities. Okay, it is structured as a trust. Now when I say it is structured as a trust, so over here the intention of this trust is pool money from the investors, invest in securities, and then whatever returns they get, they are supposed to return it back to the investors. So this is the intention of the trust. So in between they will just charge their expenses per annum. Typically around 1 to 2.5% around charges are charged by the trust, and all the profits are returned back to the investors or further reinvested for further buying more securities. So that's how they manage as a trust. Now similarly, for hedge funds, even similar one. So what is the similarity and what is the difference? That's what we need to see. Similarities, even this is also an investment vehicle and they also pool money, but however not from the retail investors. They pool money only from the accredited investors. What do you mean by that? Investors who are well aware about the market. So like high net worth individuals and institutional investors. They pool money only from these categories and they invest into various securities to gain maximum profit. Now they are structured as a partnership firm or as a liability limited company. As a partnership firm, when I say or as a liability limited company, so you will not find plenty of investors the way you find in mutual funds. In mutual funds you will find lakhs of investors. Over here hardly like 50 to 100 people come together and then they form this hedge funds. Okay, wherein the general partner is the one who will lead. Okay, so I'll take you through in written version like how it works. So imagine, so let me explain over here. Imagine an investor. So can he invest directly into securities without any mutual funds route? Yes, he can. He can directly buy securities like ICICI. He can buy ICICI. He can buy Mahindra and Mahindra. He can buy okay. So he can buy TCS. He can buy so all these companies he can buy on his own. Okay, he can buy Infosys, right? He can buy SBI Bank. So he can buy all this on his own. However, imagine if he is facing some issues to directly buy and sell these shares. What could be those issues? Maybe because he doesn't have knowledge. He is not coming with finance background, so he doesn't have knowledge about when to invest and when to exit. So because of which he is not able to invest directly, or maybe because he doesn't have any research team to advise him. Okay, he doesn't have any research team. He doesn't have big advanced systems to do research and then invest, or maybe he doesn't have time because he is already working in some company and so he has no time to do research. So based on all these reasons, now there are many people like him in the market who have savings, who have money, but they are not able to directly invest into the market. So this gave rise to an intermediary called as mutual funds. So going by this word mutual funds, mutual as in commonly agreed money, pooled from the investors. This money is pooled from the investors. These funds are pooled from the investors and it is invested into various securities on behalf of these investors. On behalf of these investors, this mutual fund is doing this work. So these investors are indirectly owning shares. Instead of directly owning through this way, they are indirectly owning shares through mutual funds. This is what mutual fund is all about. Okay. Now these mutual funds, to to make sure that everybody can invest based on their requirement, it has been categorized into open-ended fund and closed-ended fund. So open-ended fund and closed-ended fund. Okay. So closed-ended fund. Open-ended fund and closed-ended fund. So open-ended funds are those funds where you can invest throughout the year. So based on the price of the units, you will be getting mutual fund units. Okay, based on price per share. That is called NAV, net asset value. That means price per share. It means price per share or price per unit. Price per share or price per unit. In India, we call this as unit. So when you invest in mutual funds, what you get is unit. When you invest in a company stocks, what you get is shares. Over here it is called as units. Okay. So based on the prevailing price, you will be getting units, and throughout the year you can invest, and throughout the year you can exit as well. So based on the NAV, you will invest and you will exit. Whereas for closed-ended fund, again, this fund, let's say this is a closed-ended fund. This fund will have an objective. Closed-ended fund, this is something like some fixed income fund for 3 years maturity. Fixed income fund for 3 years. For 3 years. So what happens is, these kind of funds will pool money from the investors, and that will be invested into some fixed income securities, and then it will get locked for 3 years. Fixed income securities, it will get locked for 3 years, and then at the end of the maturity, all the profits will be pooled and that will be returned back to these investors. This is closed-ended fund. Okay, and so there are many types of funds also based on the investment style. This is open-ended and closed-ended based on the structure. Okay. Otherwise, based on the investment style, also there are many types of funds. For example, equity fund. So in equity fund, money pool will be invested into all equities. In debt fund, money pool will be invested into all debts. In, let's say, money market fund, money pool will be invested into all money market instruments like commercial papers, treasury bills, okay, repo, reverse repo. It will be invested into this kind of instruments, repo. Hybrid is a mixture of all this. Okay, hybrid funds, so it can be invested into equity fund, debt funds, money market funds, wherever. Okay, so these are some of the types of funds based on the investment style. So this is about the basic introduction about mutual funds. Now when we speak about hedge funds also operate in the same way. So hedge funds, they also pool money. So they are pooling money and they are also investing in various securities. But still there are some differences between hedge funds and mutual funds. So what are these differences? So number one, they pool money only from these accredited investors. When I say accredited investors, only from HNIs, high net worth individuals, and from institutional investors. Institutional investors means institutions, corporates, companies, institutional investors. So they will pool money only from these investors, not from common public or not from retail investors, and it will be invested into various securities. Okay, so the structure is a bit different. As I said, it is structured as a partnership firm. So you will not find plenty of investors. You will find hardly around 50 to 100 investors for hedge funds. And what are the other differences? We'll see one by one. Like I told you the meaning, it pools money from HNI and institutional investors. Then I also told you the structure. Then regulation. So regulation perspective, hedge fund is not a regulated one. Why it is not a regulated one? Because already it is catering to all sophisticated investors, accredited investors. Okay, so it is not regulated. Whereas for mutual funds, it plays with the common people's money. Because it plays with the common people's money, it is highly regulated from by the regulator. Okay, so for example, in India, it is regulated by SEBI. In India, it is regulated by SEBI. Okay, whereas hedge fund is not regulated. Then strategies of investments. See, for mutual funds, the intention is, first intention is to safeguard the the principal capital. So they are very conservative, and so they don't invest in derivatives. They are not allowed to invest in derivatives, as derivatives are very risky instruments. So they are not, generally they are not allowed to invest in derivatives. They can invest in derivatives only for hedging purpose. Otherwise, they cannot invest into derivatives for making profit out of it. Whereas for hedge funds, derivative is a major segment. They heavily invest in derivatives and they take huge risk, okay, in derivatives. So this is one major difference in terms of investment style. Then minimum investments for mutual funds, as they cater to all common public, minimum investments is very low. It is as low as, even with 500 rupees you can invest. Whereas for mutual funds, that is not the case. You require minimum 1 crore to invest in hedge funds. Okay, then performance fee, for hedge funds, for mutual funds, they charge around 1 to 2.5 percentage expense ratio they charge from the total assets that they are managing. It's called assets under management. So if they are handling, imagine 1,000 crores, so they will take expense ratio, for example, let's say 1%. So they will take 1% of this 1,000 crore, and that will be used for paying salaries, for marketing, and for all other expenses in handling the funds. So that's the only expense for the mutual funds. Whereas for hedge funds, they also charge expense ratio, but however, along with expense ratio, they charge performance fees as well. They charge performance fees. So when I say performance fee, typically around 20 percentage of the profit is given to the fund manager. So the performance fee is also charged for hedge funds. Then risk. So based on whatever I have spoken so far, so hedge fund is highly risky because they deal heavily in derivatives, whereas mutual fund is comparatively not so riskier in comparison to hedge funds. Okay, yeah. Then next one, number of investors. I told this one, like for mutual funds, plenty of investors because it caters to common public. Whereas for hedge funds, it is hardly around 50 to 100. Objective of the fund, for mutual fund, investment is done based on the objective. Like equity fund, they should invest only in equities. Debt fund, they should invest only in debts, and hybrid funds can be a mixture of all this. So these are objectives. Based on the objectives, they are supposed to invest. Liquidity, open-ended funds are highly liquid throughout the year. You can invest and exit as well throughout the year. Hedge funds, they have restrictions on entry as well as exit. Yeah. So that means if they want to exit from the fund, they cannot exit whenever they feel like. They will have to give notice like 1 month, 2 months before itself, and only then they can exit. So these are some of the differences of mutual funds and hedge funds. All right. Thank you so much. Thanks for your time.